Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly preview and review, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the couple of disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be stories or narratives, long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal really is to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them either along the way, and you can type out those in the box, and then I'll hope to answer them as we go, or at least after the webinar finishes. This week we'll look at, well, there's so much to get through, of course, this week. We'll initially look at Powell's testimony, obviously, over the course of last night, and the market reaction to that. Then we'll look at very briefly some of the last week's data points, and also the RBA, which obviously hiked by 25 basis points on Tuesday overnight. Then we'll preview the main events upcoming, so the non-farm payroll report in the US out on Friday, as well as, of course, two central bank meetings. That's the Bank of Canada meeting in a few hours, actually, and then the Bank of Japan meeting overnight, Thursday night, UK time. As I say, a lot to get through, a lot of risk events, of course, in the next few days, and I should mention as well, next week, US CPI data Tuesday, Wednesday is actually UK budget, Thursday is the ECB meeting, and then the following week we get the Fed, of course, the Bank of England, and the SNB actually as well, the Swiss National Bank. So a lot of volatility potentially ahead, and a lot to look forward to, and hopefully quite a few trading opportunities. Okay, we can see we just have put this sort of usual feature on now. Always interesting to compare what's happened over the last couple of weeks. This is year-to-date performance. You can see on the left-hand side a couple of weeks ago, and I've just taken a clip of that. On the right-hand side, that's where we are currently sitting. You can see how King Dollar, as I said, has come to the fore really now, outperforming quite strongly against all the other major currencies. You can see as well the euro is now the next best currency, so the best performing currency apart from the dollar. Certainly all this hawkish expectations for the ECB for them to hike quite a lot more, and we'll get into that over the next few months anyway. Their hiking path reset really, and being rather really quite hawkish, and then against that we have the yen still struggling and weakening even more actually, and the contrast of course between their uber dovish, if you like, policy stance measures compared to the rest of the world certainly, and compared to the US is obviously pretty stark. So yeah, just highlights there from a couple of weeks ago compared to a couple of seconds ago really when I clipped that. But yes, generally markets, well, they actually entered the week on a pretty steady footing, buoyed by the strong end to last week from stocks. And they continue to hold up pretty well despite that big rise in bond yields. This was at the start of the week. The dollar, interestingly, didn't find too much support from the slightly lower than expected Chinese growth target for 2023. That came out over the weekend at 5%, and 5.5% to 6% had actually been expected. So a kind of more modest goal, if you like, from the Chinese authorities, really trying to restore in a way Beijing's credibility after missing last year's target, which was around 5.5% by quite a wide margin for the first time ever. It generally suggests then that there might not be any large stimulus measures going forward, and it also indicates really the government is seeking to strike kind of balance between supporting the economy and strained finances, as well as then preventing kind of spiraling commodity inflation. Obviously, everything's been shaken up pretty much by Fed Chair Powell's semi-annual testimony yesterday. We do get him in front of the Senate, I think, today, but generally he doesn't really change the script very much. Yesterday, he certainly sent a really clear message that the Fed is back in the driving seat. He really chose to go pretty large, actually, on his inflation fighting credibility. That, again, in stark contrast in a way to the recent FOMC Q&A session, when he kind of surprised markets with a much more dovish bias. Instead, yesterday, he really surprised to the hawkish side, triggered a strong dollar rally to 3-month highs and a sharp sell-off in stocks. Cyclical currencies, especially under the pump. The Aussie was the worst performer after the RBA's dovish hike on Tuesday. We just pulled up a chart here, courtesy of Bloomberg, actually, just showing you the predicted Fed funds rate for later this year. And we can see the light grey line, actually, that was the implied policy rate back on the 1st of February, so after the Fed meeting, and then I just need to check something. Yeah, just after the Fed meeting on February 1st, and then you can see the light. The black line was just before Fed Chair spoke, and then the blue line is after he spoke. So you can see sort of rates a month ago after the Fed, the peak rate you can see there, sort of not getting above 5%, and then dropping quite sharply. We were pricing in rate cuts, of course, by the back end of this year. And then we've certainly changed this pricing of the Fed. It's got a lot more hawkish. We've had a bunch of much stronger than expected data. Obviously, the CPI report as well, surprising to the upside, really. And you can see then the repricing of the Fed funds rate. Now, yes, much more punchy. Just going, looking at that pricing, but just thinking about what Fed Chair Powell said, he obviously put a bigger rate hike firmly on the table for the March meeting in a couple of weeks. He indicated that higher eventual peak in policy rates amid that the economy faring really much better than expected, as I've just mentioned. Notably, he said there was little sign of disinflation in contrast to his previous remarks. And that really signals that policymakers are definitely concerned about underlying inflationary pressures, of course, highlighted by that recent CPI data. He said, Fed Chair Powell said, the FOMC also needs to see a softer labour market as it remains very tight, with wage growth still uncomfortably high, even if it has eased modestly in recent months. So the markets, yeah, they really reacted sharply. That's the Fed funds rate, this chart ahead of us. Peak Fed funds rate now seen at 5.6%, just above that, actually. So that's 10 basis points higher. So here is the peak here, sort of late summer. Now it's, above 5.6%. That is, yes, at least 10 basis points higher than before the speech. And there is now around a 73% chance, I think, of a 50 basis point hike at the March meeting. That's from below 30% yesterday before he spoke. We note the Fed's blackout period. That's when Fed speakers really aren't allowed to speak 10 days before the Fed meeting, the weekend before. So that blackout period starts on Saturday. Otherwise, really the key question, of course, is whether the dollar will build on its upside breakout. We'll look at that chart shortly, but data, of course, will be key going forward. Interestingly, I think some economists expect a kind of reality check in some of that sort of blockbuster data we have seen after kind of the softer weather, warmer weather, if you like, seasonal factors really kind of boosted that data we saw in January. So whether we get a sort of reining in and a reversal of that data is obviously going to be key for markets, for the Fed as well. Certainly, though, the fact that a hard landing for the US economy is kind of rearing its head again. There is a lot of eyes, a lot of focus on the yield curve. Don't want to get into that too much. People obviously saying about the inversion being at its highest in many years. That is the inversion being the gap between the 2-year Treasury yield and the 10-year Treasury yield. That gap being over now, or sort of negative 100 basis points or so. Just looking at that, yeah, about around 103 basis points now. If you think the 2-year yield is above 5% and the 10-year yield is still below 4% now, so over 100 basis points of inversion. Just one thing to note there, and I know if you follow Twitter, you use TweetDeck, you get a lot of people commentating on the fact that this means a bigger recession. It doesn't mean a bigger recession if that curve inversion gets wider. It just means more investors are more convinced that a recession and a cut in rates is coming. So the slowdown won't be worse just because the curve inverts. Just something important, I think, to take note of. Anyway, yes, so markets reacting strongly, as I said. We got a stock sell-off as well. Fears about a hard landing, of course, and data now all important. NFP, of course, Friday. We'll look at that soon. US CPI, as I said, next Tuesday. We also get some labour market data actually today. The JOLTS vacancy survey. Now pretty widely followed, never has been, but especially now. And then we get tomorrow's weekly initial jobless claims data. So just worth bearing in mind, just watching those, because, as I said, data is key now going forward, and whether it confirms this new leg of hawkish repricing. Just probably want to go to some stocks now, and here, yeah, we just got the S&P 500 weekly charts, but certainly, yeah, equities, US equities turned sharply south yesterday on this hawkish pivot by Powell. Clearly not comfortable with the most recent data. And the S&P went back below the key psychological 4,000 level, though with some way to go before the 200-day moving average comes into view. That's now around, let's get rid of that. The 200-day moving average is now around 3,940. We've just pulled up the weekly chart here, as I said. Don't want to get into these lines too much, but this strong long-term trend line resistance you can see there now becomes strong support. Also, we have a long-term fib level, the 38.2 fib level, around 39.84. So that coincides, or is just above actually that long-term trend line support. That's on the weekly, and you've also got the 50-week moving average at 39.91. That's now just above yesterday's close. If we do move to the daily chart on the S&P 500, you can see I sort of drew in a descending wedge there. So we had that break to the upside, sort of. It's kind of a reversal pattern. A reversal pattern shows up when prices move downwards to a sort of pivot, and the highs and lows converge really to a single point. So you did get that break to the upside, but otherwise then you can see that plunge lower from yesterday, sort of bearish candle the day before on Monday really, where we had a reduction actually, you can see there, of the prices to the upside. the high at 4,078, and we closed really near to the lows. So yeah, we've pointed out that fib level 38.2 at 39.84. That may act as some support, but then we do get down to the 200-day moving average. You can see here, that's the black line. That also converges with the 100-day moving average at 39.35. So really strong support, you would think, around those levels for the S&P 500. If we just go to the NASDAQ, this is the NASDAQ 100. Just on the weekly again, always like to sort of zoom out to a wider time frame just to get a sort of bigger picture of where prices are. So on the weekly, the NASDAQ 100, we can see big support around the 50. Well, it's the 50% mark of the pandemic rally here. So that's at 11,768. So a long-term fib level, if you like. And then we also have the 200-week moving average. That's that black line, which coincides really with the 50% mark. That's at 11,703. And then you also have that sort of falling trend line sort of coming, probably should extend that now, which would come now below there. So really initial support, long-term support anyway, we see it 1168 and 11703, 200-week moving average, and the 50-day point of the pandemic rally, so the halfway point, that is. If we go to the daily, we can see the 200-day moving average, and we're still quite some distance from that at 11,901. Then the 50-day moving average at 11,821. This is on the NASDAQ 100. Also then go to the Dow. Just pull out the weekly again. You can see a lot of noise here over the last few weeks, really. The 50% marker again, this is a shorter term fib level I've drawn in here. That's from sort of the 2022 decline actually. And you can see the 38.2, sorry, the 61.8 actually is at 33,806. Couldn't really get above that. I've still left in this key sort of mid-August pivot high, if you like, at 34,281. Struggled to get above there and to close above there, and you can see those sort of narrow range candles, doji candles, sort of signaling indecision. And then we the more consistently say this, but the more you track sideways in narrow ranges, the more then you'll get a bigger breakout and range expansion essentially. We had that 21st of February, you can see there, breakdown. We've sort of been messy as well after that sort of push higher last week, and again now we're testing a fib level. That fib level being the halfway point of the 2022 decline. That's around 32,834, and you've also got the 50-week moving average now at 32,598. That you can see has acted as quite decent support actually over the last few weeks. Just looking at the daily, top side capped probably by the 50-day moving average at 33,529. And then you've got, well, we broke through the 100-day moving average at 33,169. So we're back to that fib level, as I said. And then the recent low is at 32,500 or so. Worth probably looking at the DAX and possibly the UK FTSE 100. The DAX really quite resilient still. I think we've pointed out that in the last few weeks, easily explained, of course, by well, investors' preference really for value stocks since the turn of the year as opposed to growth stocks. Europe heavily weighted towards that, or those stocks really, value stocks. Then, of course, we've had improving sentiment towards China with the reopening. That's a key driver for German stocks especially, and the German economy. And you can see there, we did actually, looks like we sort of broke out of this sideways trading on Monday, hit a new cycle high at 15,677. So breaking that previous high at 15,658. But then obviously that sell off yesterday, not too large really. And we just sort of we're holding steady, but sort of back in this range. So interesting whether we can break then above yesterday's high at 15,706, or whether we then just push back into the range. But key, of course, is that we hold that range at the low in the range, sorry, at 15,150, and also then that 100-day, sorry, the light blue line is the 50-day moving average at 15,136. So that's in the DAX. FTSE, quite interesting because we did push higher in the middle of February, above sort of 7,903, that long-term high back from 2018. We pushed up to 8,047 there, but then back to the sort of long-term trend line, which had acted as resistance and now potentially is acting as support. We've drawn in there sort of medium-term uptrend, which has acted as support. We're just sort of below there, so critical level for the FTSE. If we do roll over, then the recent low around 7,854 may come into view, and you've got the 50-day moving average, that light blue line at 7,820. Okay, that's sort of stocks, how we see the technical levels, and of course some of those fundamentals after Powell. Probably worth looking at, as I said, just briefly looking at some of the data from last week. We had an ongoing rebound in Chinese PMI. Manufacturing actually, you can see from the chart here, expanded at the fastest pace in a decade. Manufacturing, I think, hit 52.6, so above the 50.1 in January. Non-manufacturing, that's services, the gauge rose well into expansionary territory of 56.3. And then the composite, that lifted that joint number, if you like, to 56.4, I think. So remember that this is the diffusion index. So when it goes above 50, it signals expansion. Obviously below 50 denotes contraction. So all the details were strong really in these Chinese reports, really feeding that narrative, that theme that the 2023 Chinese recovery is definitely on track and really the real deal. Also then we had, well, I've got the global PMIs actually, just a sort of tracker of that, and you can see for the first time since August, it's gone above, just above 50 as well. So that's a global PMIs kind of leading indicators, if you like, for the global economy. We also had ISM data out of US last week. Worth pointing out, manufacturing rose, still below 50 though, rose to 47.7, so remains in contractionary territory, but it broke an 8-month-long decline. More interestingly, and what markets paid most attention to, was prices paid. So that's a kind of sub-index, if you like, but really an inflationary gauge on price pressures. That jumped to 51.3 from, you can see here, from 44.5. So it suggests that producer prices, they're rising still again, instead of course, being vice versa, if you like, albeit at a slower pace. Markets, as I say, they concentrated on that. They're focusing on, of course, data, price pressures, inflationary pressures as well. Context for this really is that, or this sub-index, if you like, don't want to get too into economics here, but for the ISM, that prices paid index was actually averaging 78 during the pandemic phase, if you like, but in the 5 years before that, so up to the end of 2019, the average was still 56. So we're some way below that still. But of course, the focus is on, at the moment, as I said, inflationary risks. Also worth noting that taken together, other data, so we've had US durable goods data, regional business surveys, they still as well point to continued weakness in business investment. Just one other piece of data we want to show you, Eurozone HICP, that's Eurozone inflation. The core rose to 5.6% year on year in February, so that's another record high. With both core goods at 6.8% and services 4.88%, they also hit all-time highs as well. So much higher than I expected. That was at 5.3%. And you could see headline. So again, another point to note. Some people focus on headline CPI, but really it's all about core now. So core obviously excludes the volatile food and energy prices, and that's certainly why headline has fallen sharply, is because of energy prices falling really sharply over the last few months. So kind of we look beyond the headline really, and you can see the divergence in a way that core is still rising while headline is falling, and that's certainly something the ECB is focused on, and ECB policymakers for sure will be obviously next week when we get the ECB meeting. But the core definitely shows how entrenched inflation is, especially in the Eurozone, and probably will be a headache really for most of the year. All the country prints, actually, just to highlight, they were released earlier last week. They came in above expectations. Germany topping estimates 9.3% versus 9%. And really, when we take this all together, really, the ECB definitely unlikely to slow the pace of its tightening, really until we get the signs of that underlying core inflation peaking, and at the moment we can't see it yet. Pricing wise then for the ECB, markets really I think pricing a further 150 basis points now by year end. So definitely a nailed on 50 basis points rate rise next week by the ECB, pretty much I think negligible really for 75 basis points, but then they go again by another 50 basis points in May. There's no meeting in April, by the way, so May another 50, and then of course, depending on that trajectory of inflation, then markets consensus really forecasting more rate hikes, but probably 25 basis points in June. That's the 15th of June, and then potentially in July, 27th of July, that is. And then we don't get another meeting actually till the middle of September. Just probably touch on euro dollar actually, because we'll move on to this week's main events. But just briefly on euro dollar, just bear with me. I'll just pull up the chart. We can see the chart here. So yeah, it really needs to hold above. You can see this sort of last line or near-term support level actually around 105.37, 105.32 or so from last week, or the week before actually, 24th, end of Feb there. So that sort of held prices, and we sort of pushed edge slightly higher before obviously that plunge lower yesterday. We also broke through the 106 sort of we've got here yeah, the 106.10 line, which is a long-term fib level of the 2021 decline. That's the 38.2 sort of retrace level, which we pushed above, then went to, you can see the halfway point just above there at 109.42, but couldn't really stay there for very long, and then we've rolled over really and back to that fib level, and through also the 50-day moving average at 107.22 that is now. So yes, initial support at 105.32.36, and potentially then at the 100-day moving average, that light grey line at 105.17. If we do lose that, then that sort of tallies with 104.81, then potentially lower. That's that sort of year-to-date low, and then potentially we go down towards 105 if we do lose this. As I sort of pointed out, actually, interestingly, euro is the best performing G10 currency after the dollar in the past month or so, and actually year to date now. So yeah, yes, definitely this hawkish sort of repricing, hawkish pricing of the ECB, but at the moment, certainly against the dollar, it's fighting a tough battle with this recent dollar strength. Okay, next we'll go to, just bear with me, we'll go to just a quick recap of the RBA meeting that was obviously out sort of Tuesday night UK time. The RBA hiked by 25 basis points as expected to 3.6%. The bank acknowledged the fact that inflation probably has peaked and should decline this year and the next year as well, to be around 3% in mid 2025, it said. It kind of noted a divergence really between sort of decelerating goods price inflation and still high service inflation. Should sort of step back. That hike was the 10th consecutive time it's hiked rates, 11-year high now at that 3.6%. But despite one more rate hike possibly being signalled for the April meeting, Governor Lowe sounded less hawkish in the wake of a recent really slew of weaker than expected data on GDP, employment, wages and inflation. Household consumption adds to this sort of theme, but is nevertheless slower or slowing due to tighter financial conditions and a softened housing outlook. We do see business inflation, business investment outlook. That's still positive, but generally the data is suggesting the RBA potentially pauses going forward. Markets, they priced the terminal rate lower after the meeting from around 4.2% to around 4%. And money markets actually are pricing out now that April rate hike, which had been seen before the meeting. As for the Aussie dollar, well, sort of recently hurt by weaker global risk sentiment and the rise in geopolitical tensions, really. You can see the fall then from the top in February at 71.57. We track sideways, interestingly, around sort of the 100-day moving average, but below the 200-day moving average there. We've got in this sort of support level, which sort of held prices back in November, December. That's at the mid-July sort of pivot low, if you like. And that comes in at 66.81, but we plunged sort of through there, sort of following on from that sort of downtrend, if you like, so tracking sideways, bearish consolidation really, and then we've blown through that 681 support level, and sort of looking now towards we've got a near-term fib level as support around 65.47 there. We have sort of, after a strong move like this, you do generally get some tracking sideways. And we're sort of seeing that today and this morning, but potentially, yeah, much rest, of course, on non-farm payroll, then US CPI in dollar Aussie. Okay, over to this week's main events then. Firstly, we have US non-farm payroll. The rate, you've got a graphic here, obviously, of the main numbers. 215,000 is the headline number then, expected to cool, obviously, from that nearly triple forecast, 517,000 reported in January. If that consensus is realised, then it would certainly be lower than the pace of the 3-month average at 356, the 6-month average 349, and then 12-month average actually at above 400,000 for non-farm payrolls. Analysts, as I say, the kind of economists really argue that the January upside may have been as a result of seasonal adjustments, and that could become a negative factor for the February data on Friday. Unemployment forecast to rise a tenth. That's from 3.4%, which was a multi-decade low. And the Fed actually projects a rate at 4.6% in 2023 there. Although we have to remember the central bank, the Fed, will update its projections, its dot plots at its meeting in a couple of weeks' time. Recent data show that job gains typically suggest higher wages, which are a source of inflation. So obviously a key focus for the street for markets will be on average hourly earnings, wage growth. Basically, they're expected to rise 0.3%. That matches the rise in January, while average work week hours are seen narrowing a touch to 34.6 hours. That means the annual average hourly earnings measure for basically for wage growth should increase to 4.7% from 4.4%, but that's basically due to base effects from last year. As I've mentioned, though, the current pace of growth in wages certainly still uncomfortably high for the Fed. And although certainly underlying wage growth does appear to be moderating, conversely across a range of other measures and lead indicators. Yeah, the rate really has gone now above that 5.5%, actually around 5.6%, as I've mentioned. But key will be for us revisions to the 517 number from January, and then kind of thinking that a slowdown certainly back to around the 200 level obviously will be lower than the 3-month average, and potentially might see a slowing up in the dollar. I haven't looked at the DXY yet, actually, so let me just go to that quickly. So the DXY index, of course, that's tracks a basket of 6 currencies against the dollar. Euro, obviously, the main weighting in this, around above 56% or so. But we can see in the dollar, obviously, certainly the underlying narrative at the moment, this higher for longer policy, that should keep dollar support underpinned really for the next couple of months, you'd like to think. Certainly as well, if they do change the dot plot and that higher peak rate, remember that was at just 5.1% in December. So things have obviously changed since then. As I say, markets pricing 5.6% or so. So that will be key for dollar support, really, where that dot plot, the average median dot plot is for the peak rate, the terminal rate. As I said, much will depend on non-farm payroll initially on Friday. We kind of think, as I said, number around 2,000. That's below the 3-month average. And certainly before Powell spoke, then there was kind of a high bar really to move it back to 50 basis points of hikes in one meeting, obviously in March. Certainly kind of doesn't do the credibility of the Fed that good when they've moved down to 25 and probably expected to keep hiking, if anything, just with the smaller increments of 25 basis points, and certainly because rates are probably in restrictive territory now. So a move back to 50 basis points is not a great look for the Fed, but they will do what they have to do, certainly to bring inflation back to its target, if you remember, at 3%. I think interesting as well that many talking about whether that target is credible now, that 2% target, and whether we do actually get there. But certainly that's just because, obviously, of this much more hawkish stance taken by Fed Chair Powell. Okay, just on the DXY, let's just get to that so you can see what have we got? Yeah, we have fallen for, had gained actually for 4 consecutive weeks, and then last week we sort of moved lower. We hadn't seen sort of 4 weeks of gains since May of last year. The 50-week moving average, you can see there, the light blue line, had capped resist upside. That's now 105.66. So interesting to see whether we can push up beyond that, and we couldn't do previously. And then just on the daily, Interestingly, people also talking about seasonals. I think we may have talked about that a couple of weeks ago. That generally looks, well, at the moment, March time, sort of boosts the dollar. And really then sort of we've capped the downsides really with sort of not really touching 103.82. We've highlighted that long-term spike high actually from 2018. We didn't really touch there, but we're trading sideways, tracking sideways, kind of bullish consolidation, although it did carry on probably for longer than we would have liked. And then we've broken higher, obviously, above the recent late February highs at 105.35, and also above the 100-day moving average at 105.30. Also went above, interestingly, the January, early January high at 105.63. Yeah, fresh year-to-date highs, possibly then going up towards then the 200-day moving average at 106.59. Okay, let's just now go to a couple of the central bank meetings, try and get through these. We've done another graphic actually for today's Bank of Canada meeting. They're expected to pause and hold rates at 4.5%. The bank actually said in January that if economic developments evolve broadly in line with its outlook, then it expects to hold the policy rate at its current level while it assesses the impact of the cumulative interest rate increases. I've put on here, actually, we've had 8 meetings, 4.25% of rate hikes. So pretty, very aggressive policy tightening. If you remember in July, I think we had 100 basis points of a hike as well. So rates now at 4.5%. As I've said, data-wise, we sort of had a battle between kind of falling inflation, falling GDP, which you can see here, inflation falling below expectations of 6.1% to 5.9%. And then GDP, as I said, that's signaled actually, well, it's stagnated actually quarter on quarter, annualized in annualized terms, and contracted actually 0.1% month on month in December. So worse than the Bank of Canada had forecast, and kind of cementing the pause. Certainly then, just against that, actually, we put in the 150k of job gains. So we still have a slightly or tight labour market as well, contrasting with the sort of slowing in GDP, slowing in inflation. Obviously, then what does a bank do? So if it's obviously, if that the pause is really conditional on the bank remaining open to hiking rates again later in the year, potentially if, say, inflationary pressures re-emerge, and we don't have to see the US for that case. So initially then, if the bank does remain open to more policy hiking, then that may give a short-term lift to the Canadian dollar. But kind of further out could be potential tactical weakness, if you like, in the loonie, as risks of a lag to US policy rate kind of broaden. And there are, of course, now other more hawkish central banks then, if Governor Macklem does hint at a kind of pause in the near term. Then kind of Canadian strength, that would be dependent going forward really on whether the dollar story then starts to weaken. This is kind of further out now, so a longer term picture, or if oil prices pick up materially, or we then as well see an improved risk sentiment. But that's, as I say, probably much further out. Just probably worth looking at dollar CAD then. Just bear with me while I get that up. That is here. You can see the charts here. Just generally CAD wise, recent domestic news really being pretty thin on the ground. CAD really then tracking the ups and downs of the dollar, and you can see obviously tracking sideways here, sort of edging higher, but couldn't quite break above 136.65 until yesterday, of course. Just on the Canadian dollar again, kind of correlation with equities has been previously quite strong, but that's sort of weakening now. It's actually the weakest since last July, although it still has the strongest correlation with stocks, the Canadian dollar, among major currencies. So don't forget that fact. Yeah, we can see it tracking the dollar, obviously dollar strength. So dollar CAD pushed up above, interestingly, sort of December sort of highs, which is December, you can see couldn't get above that sort of 137 level. So interestingly, whether or how much higher we go here, support certainly sits around a minor fib level at 136.82, and then potentially then we have these sort of spike highs at 138.08, and then potentially 138.54 if we do go higher. It is as well Canada's jobs data actually on Friday as well, so you get non-farm payroll at the same time as Canada jobs. I think estimates for that much lower than last month's 150,000. I think estimates around 10,000 or so for Canada jobs that released on Friday. Okay, otherwise then we also get the Bank of Japan meeting, of course, that's out overnight on Thursday. Sorry, just checking, not checking, but just checking something else there. So yeah, Bank of Japan expected to keep policy settings unchanged at its meeting. That means leaving rates at negative 0.1%, maintaining yield curve control to flexibly target, of course, 10-year Japanese government bond yields at around 0%. This, of course, is the last meeting with Governor Kuroda at the helm, whose term will then end in early April, as well as actually two deputy governors, which who will be finishing their terms this month. Just as a reminder, the Bank of Japan's kind of defied increased speculation for a policy tweak at its last meeting in January. It basically maintained rates and the parameters of yield curve control, and it also stuck with the forward guidance on rates, saying it will continue with large-scale Japanese government bond buying. It also actually reiterated that it will not hesitate to take additional easing measures as necessary. Rhetoric from the Bank of Japan since that meeting has been or remained dovish, really. Kuroda stating he's resolved to keep ultra loose policy, and that the Bank of Japan really expects consumer CPI, so inflation, to slow beyond 2% this year and next year. And as well, one of the deputy governors noted again as well, it's appropriate to maintain ultra loose monetary policy. So it would be a real shock, really, if there were any tweaks to policy. I know there's a lot of speculation because it's Kuroda's last meeting, but it really seems quite unlikely to us. That is his last meeting after, of course, a 10-year stint, which began actually with the announcement of QQE actually way back in April 2013. Really, then markets are looking to the next bank chief to steer the Bank of Japan towards potentially an exit from this loose policy. Although, of course, we do note the nominated successor, that is, of course, Ueda, doesn't seem to be in a rush to normalize policy. He recently noticed that the current policy stance is appropriate as well. Japan still needs more time for inflation to sustainably hit the 2% target. Ueda also actually said it's appropriate monetary easing for now, and suggested the Bank of Japan would either need to move towards monetary policy normalization or consider ways to maintain YCC, actually depending on inflation whether it significantly improves or not. So yes, key will be after this meeting then obviously Ueda's first meeting, but in the meantime it kind of seems they are on go slow still. And we can see, just looking then at dollar yen, That's certainly driven by US yields in the near term. I've drawn this sort of rising wedge potentially, which is a reversal pattern, so opposite to what I drew previously. It's a reversal pattern seen in bear markets, and as I said before, it shows up when prices move upwards with pivot highs and lows converging towards a single point, an apex, and then you get a breakdown lower. But at the moment, that kind of hasn't happened. It's kind of a bearish, a bullish channel, if you like, from those lows seen in mid-January at 127.21, and we sort of series of higher highs, higher lows. As I say, if we keep this line of support, then potentially we are pushing up towards, we've gone beyond that 100-day moving average at 136.23. So the next line is that 200-day moving average at 137.41, and you can see we pushed above there today before pulling back. So interesting to see whether we can break that, and then we look towards sort of 138 and above potentially, if that rising wedge pattern doesn't happen and we break down lower. Okay, that's all we have time for today. Thank you so much for listening. Good luck out there. A lot of events to look forward to, a lot of volatility expected. So yes, watch out for the headlines. Keep your position sizes relative to your trading pot, and we will speak to you again in a couple of weeks' time. Okay, take care.